You say that the world has gone mad and the system, meaning capitalism, is broken.
Hey, what is up, guys? Ray Dalio, the founder of Bridgewater Associates, the largest hedge fund in the world. His net worth is estimated at $18.7 billion. Only a few days ago, he stated that the world just got mad and the system is broken. In today's video, I will explain what he means by that and what we should expect. Now, let's see what can we learn from historical recessions and financial bubbles. According to Ray, every bubble is a large accumulation of debt. We are currently at new all-time high of corporate debt, and national debt is also at new all-time high, almost at $23 trillion. In 2018, according to Ray Dalio, that was not that big of an issue, and he indicates that we are probably in the late stage of the financial cycle. This few minutes clip interview that you're about to see was made back in 2018, and Ray stated that we are probably 2 more years until this 11-year financial market expansion will come to the end. Let's take a look what Ray Dalio had to say 2 years ago, and we will compare it to what he has to say now.
When you look back and think about the crisis, what is the biggest single lesson? I know there's so many lessons in the book and we want to get to them, but the biggest single lesson for you?
Of all of them, there's the debt growth that finances the bubbles that happen before it that create the busts. You know, there's basically 6 stages to it. There's the normal debt growth that finances growth that pays for itself. Then you get into the bubble stage when everybody's extrapolating what happened in the past. So asset prices are going up and everybody's borrowing a lot of money to extrapolate what's happened. And that bubble stage, central banks don't pay much attention to because it doesn't affect inflation and growth. And so I think at that stage is when the central bank should be looking at, are those debts going to be able to be paid back from the financial? That would be the biggest.
Right. And what stage, therefore, are we in today? We had a segment on it around 6:30 with Brian Sullivan, who talked about actually how debt in this country has actually increased since 2008.
Yeah, debt has increased, but debt relative to the debt service payments relative to incomes have not risen like they've had in 2007 and 8. So
his point was looking at corporate debt in particular.
Corporate debt, of course, is levered. But if you look at the corporate cash and you look at the maturity of the debt, when we run the pro forma financial calculations, it's nothing like 2007, what looked like to 2008. There's a squeeze that'll be emerging, but generally speaking, we're in, I would say, the 7th inning of this cycle. I think that we're at the stage in the cycle where interest rates are being raised. Right. We're in the later stage, probably maybe we have 2 more years, I would say, into the cycle, something like that. And then the issues of this debt crisis are very different than the last debt crisis. Right. Each one's a little bit unique. This one looks very much more like the 1935 to 40 period.
You mean debt situation? You called it a crisis. We're not at a crisis yet, are we? Are we there now?
No, but
you mean the debt situation?
Can I describe the parallels?
Yeah.
Because I think the parallels are really important to understand. Okay. 1929 to 32 and 2008 to 2009, we have a debt crisis and interest rates hit 0. Both of those cases, interest rates hit 0, only 2 times this century. There's only one thing to do next, and that is to print money and buy financial assets. So in both of those cases, that's what the central bank did, and they pushed asset prices up. As a result, we had an expansion, we had the markets rising, and we particularly had an increase in the wealth gap. Because if you owned financial assets, you got richer. And if you didn't, you didn't. And so what today we have is a wealth gap that's the largest since that period. The top 1/10 of 1% of the population's net worth is equal to the bottom 90% combined. You have to go back to 1935 to 40. As a result, we have populism. Okay, populism is the disenchanted. Capitalism not working for the majority of people. So we have that particular gap. So we have a political gap, a social gap in terms of the economics, and we're coming into the phase where we're beginning the tightening cycle. 1937, we begin a tightening cycle. we begin a tightening cycle at this point. No tightening cycle ever works out perfectly. That's why we have recessions. You can't get it perfectly. So as we're going into this particular cycle, we have to start to think, well, what will the next downturn be like? We're 9 years into this. As you have a downturn, I believe that there's a political and social implications to that related to populism and less effective monetary policy. There's less effective monetary policy because so far there are two types of monetary policy used. Lowering interest rates. We can't lower interest rates. And the second is quantitative easing, and it's maximized its effect. So I think that the next downturn is going to be a different type of downturn. I think pension problems, healthcare problems in terms of obligations that are not funded, that are not debt.
More severe next time?
I think it'll be more severe in terms of the social, political problems, and I think it'll be more difficult to handle. It won't be like the same in terms of the big bang debt crisis. It'll be a slower growing, more constricting sort of debt crisis that I think will have bigger social implications and bigger international implications.
There's a sense in this book that there's inevitability to these crises. And so one of the questions is, from a policy perspective, if we're in the seventh inning, is there anything that policymakers can do today, not afterwards, but today, to avoid this crisis you're talking about?
I think, first of all, to be able to think about how to handle it, because you're right, they're inevitable. They're inevitable because there's never the perfect balance between lending and borrowing, right? And so they're inevitable. I would say the things that they should do that maybe are missing are, first of all, to have the freedom of action. We have a lot of regulations, and they're usually written for what the last debt crisis was like, and ours are. But there are less freedoms of action today. We have a safer banking system, and we've done a lot of things to make it safer, but each one is a little bit different. Classically, there's the development of the shadow banking system, and we will have a new type of shadow banking system, so less freedom. I think we have to think about what is the monetary policy 3, as I call it, that is not going, that when we have quantitative easing not being as effective.
That's what I mean. I mean, is the
and then the
prescription,
third thing,
would the prescription for that, though, be to raise rates now and try and unwind the balance sheet as fast as possible? Because that would bring on.
If you raise rates now, all the rate structures affected and carries through all markets.
Right.
Because we're all it's a discount rate for the present value of all asset classes. No. I think you have to start to think of what monetary policy 3 is, which is, particularly in Japan, you're going to need it, but the type of thing where it's not just the purchase of financial assets, it gets individuals to make their purchases.
Back in 2018, Dalio was clear that we are not in the recession just yet, but it most likely will happen in 2 years or so. Another important statement that he made, which resonates with me, is that each market cycle and financial crisis is different than the previous one. People most of the time learn from their mistakes, and they are likely not to repeat them in the near future. But it's a human nature to make mistakes, and every new generation keeps falling in the same rabbit hole. That's why history not necessarily repeats itself, but it often rhymes. Now let's go to the current time. Just a few days ago, Ray Dalio had an interview with CNBC, and he stated that the world just got mad and the system is broken. What does it say about economic system when some of the wealthiest, most prominent beneficiaries are coming out and declaring that it is a failure? Let's see what he had to say in that interview.
You say that the world has gone mad and the system, meaning capitalism, is broken. You point to things like the wealth gap and the printing of money and monetary policy, unfunded liabilities. What are we going to do about it?
Well, let's first touch on what it is, okay? The necessity of trying to be stimulative when there are not other monetary policies. You can't lower interest rates anymore. There's been a lot of printing of money. And as a result of that printing of money, investors are very flush with money. And as a result, they're taking very low returns. And they also are buying dreams rather than earnings in stocks. So we've pushed that to an extreme in terms of those returns. And then at the same time, it is clogged with investors. So investors have an abundance of money. And then we also don't have much in the way of the trickling down. So we do know that we have populism of the left and populism of the right. And we're going to come into a period of time where that's going to be more challenging, and it'll have big effects on the markets, because it'll have a big effect on tax policy, but it'll also have a big effect on how we are together. So if I take those things, the large populism of the extremes and the battle between those two, and then I take the absence of effective monetary policy and the conflicts that we're having in the world, that's the nature of that market. So I believe that we would need to have smart togetherness to engineer a process by which the system works better to produce more equal opportunity, and also can raise the size of the pie, because there are a lot of good investments in education. If we're underfunding education, or if we're doing a number of things that could produce high return on investment, we'll be better off. And so that's my basic perspective. And then also, I'm pointing out that the pushing to negative rates, we're running out, and that's going to lead to fiscal and monetary coordination necessity. That is very dangerous. We're going to have large budget deficits, large debt. We're going to need to fund those liabilities that we have. We have pension liabilities and health care liabilities. That means there's going to be a lot of printing of money, and what that looks like is important. So that's what I'm saying. The system is not working efficiently, monetary and fiscal policy, and the means by which there's a equal opportunity is not working efficiently at a time when we have the circumstances we have.
So whose responsibility is it then to fix it? You pointed out a very scary situation here. Is it corporate America's responsibility to fix it? Is it the government? Is it individuals in this country through philanthropy? Who's going to solve this?
I think it can't be done in a fragmented way. I would say the leadership, whether it's the president or the state leaderships and governors and so on, has to take an approach where it's a come-together approach of different types of people. I'm not saying this is likely. I'm saying it's necessary, because we're going to a war-like environment. And so the smart people who are in contact with various on-the-ground needs to realize that they have to engineer it together to make sure that our economy works well. Education, for example, if you look at the education statistics, we have to improve education. It's a hell of an investment. So I think that's the nature of the beast, that it has to be top-down directed. It's got to be coordinated. It's got to be nonpartisan or bipartisan. And I don't think that's likely. I think what's most likely is that as we move ahead, there'll be more printing of money that's necessary to fund those deficits. There will be bad returns because they'll be driven down, and that the dreams of selling companies that no longer, they're selling dreams, they're not selling earnings, and they're not even selling a path to earnings, that those things will have to be normalized, will have to be rectified. Time will produce a paradigm shift. There'll be a paradigm shift where those things that supported the economy and the markets in the past will increasingly be in jeopardy.
Now, in the last, few years, we've seen, obviously, on the fiscal side, tax cuts. We've seen on the monetary policy side, we're now in a lower interest rate regime. Would you recommend reversing some of those things to accomplish your goals? Do rates need to go higher from here?
No, I think the system is pretty much stuck. You can't raise rates because, as a result of the stimulation, companies and various entities have a lot more debt. So it's stimulated. the borrowing and the purchases of companies back with borrowed money and all of those things have produced the stimulus. You know you can't, if you do reverse it, it will have the effect of causing prices to go down. Let's say if we reverse the tax cuts, okay, and we're looking at different proposals. The proposal to reverse the tax cut and change Elizabeth Warren's, for example, would result probably in about a 15% change in earnings. That would be a 15% change in tax, the value of stocks and earnings. So each one of those things, if you reverse them, you're going to reverse some of the things that happen, and that has enough consequences. So I think you have to engineer things carefully. I think that there's lots of good investments that can be made in some things. That we're going to need to raise taxes. But the question is how it's well engineered and whether we're doing that in a bipartisan and a nonpartisan basis. There are no simple answers because when we run out of monetary policy, we've run out of the stimulant that we usually can go to deal with that situation at the same time as there's this polarity.
The system of making capitalism for the most people is broken. Dalio. It began with financial crisis a decade ago, when central banks around the world began printing money by trillions in order to stem off financial collapse. The banks used that money to buy bonds, putting huge amount of cash into the hands of large investors, like banks and wealthy individuals. Those investors were supposed to spend that money, which would have to put into the consumer economy and result in job creation. But it has not worked. The reason that this money are being pushed on investors is not pushing growth and inflation much higher, because investors who are getting it wants to invest in rather than spend it. Dalio. And so they have invested, driving up the stock market to dizzy highs, and even as wages stagnate in the real economy, the S&P 500 stock index hits an all-new time high last week, with investors pretty much ignoring the economic slowdown in Europe and China, and seemingly convinced that the US-China trade war is about to end. Like many other observers, Dalio has noted that the stock price no longer has much to do with the health of the company and earnings. Market moves depend on whether or not investors expect central banks like US Federal Reserve to float the market with even more money. In the bond markets, there is so much money floating around that investors are willing to accept less and less return on that money they lend. For many government bonds, especially in European countries, the returns are below zero, a negative interest rates, which means if I give you money, I will also give you interest on that money. This is insane. When money are more than free, people will do dumb things with it, which will not end well. Investors are willing to accept negative interest rates, getting back less and less than they lent because they have an enormous amount of money to invest that they had ever before. So the money rotates around financial system from central banks to investors and back again, without passing through the hands of regular people, the wage earners who depend on that capital for their income. And while those who have wealth are able to borrow virtually for free today, those without wealth cannot access to capital to improve their situation. Therefore, we have a huge gap between rich and poor. Ray Dalio says that the whole situation is likely to get worse because governments around the world have been borrowing large amounts of money, and those amounts will get even larger in the next economic downturn. The most importantly, in this financial recession, we will see a paradigm shift. I believe those who hold Bitcoin and gold will be initial beneficiaries. Let me know what you guys think about Ray Dalio and his statement about this current economy. Leave your thoughts in the comment section below, hit that like button and subscribe.